Hi, Mike Almali back with this last lesson in Financial Accounting and Mercifully Brief Introduction. Financial statements cannot be useful if they are based on unreliable and inaccurate recordings of transactions. There's no greater example of garbage in, garbage out principle than financial statement preparation. The problem is that financial statement users cannot usually assess the presence of garbage simply by reading the statements. The statements may look fine, but in reality be riddled with inaccuracies. The two main sources of financial statement inaccuracy are deliberate dishonesty and incompetence. There are two principal ways to combat these problems. The first method is to regularly hire an outside accounting firm to audit the financial statements. In an audit, the outside accountant tests reported account balances for accuracy. As importantly, the auditor tests to see that the accounting principles used in recording transactions are in conformity with GAAP and applied on a consistent basis. The second method used to prevent fraudulent and inaccurate financial reporting is the adoption of adequate internal controls. Internal controls are the policies and procedures that a business can adopt to safeguard its assets, ensure accuracy of financial reporting, and prevent fraud. These methods, of course, are not mutually exclusive. In the best of all worlds, firms would have both good internal controls and regular audits. Unfortunately, hiring outside auditors and having the very best internal controls can be very expensive, especially for small firms. For many, if not most small businesses, regular audits are an unnecessary expense. The same cannot be said about adequate internal controls. Even the smallest business can benefit from well-designed and implemented controls to prevent fraud, theft, and accounting errors. And in fact, small business owners are more likely to be the victims rather than the perpetrators of financial statement fraud. All too frequently, a lower-level bookkeeper or accountant will cook the books in order to cover theft and embezzlement. For this reason, it is important to have some understanding of internal controls. There are several widely used internal controls procedures to prevent employee theft. Three of the most important controls are employer bonding, segregation of duties, and budgeting. Bonding is a form of commercial insurance that indemnifies a firm against employee theft. Segregation of duties ensures that employees who handle cash or other assets do not also have access to accounting records. This prevents employees with access to both assets and accounting records from covering up their thefts. Here's an example of inadequate internal controls. Ms. Feasons is the bookkeeper for a small law firm. Her job responsibilities include writing out checks and recording the disbursements in the check register and computerized check journal. She is also responsible for performing the monthly bank reconciliation. She notes that the owner never looks at the canceled checks, so every month she writes a couple of $100 checks to herself, but records the disbursements as payments to a process server the firm uses to serve subpoenas. Neither the owner nor the outside accountant ever look at the canceled checks. All they see are the entries in the general ledger. Because the firm normally spends between $1,500 and $2,000 a month in legitimate process service costs, the extra $100 or $200 payments go unnoticed. The above fraud could have been prevented by not letting Ms. Feasons have check signing authority. If she had check signing authority, someone else should have entered the disbursements in the general ledger and performed the bank reconciliations. Budgeting is the process of predicting the operating revenues and expenses for the next accounting period. This process serves again as an internal control when owners regularly compare current actual revenue and expense with budgeted amounts. Failure of actual results to fall within a reasonable range of budgeted amounts should cause the owners to investigate the reason for the variance. As an example, if the owner of Ms. Feasons' law practice would establish budgets for expenses and revenue, the extra $200 a month she was pocketing and recording as process serving fees might cause a variance that could be investigated. Most frauds occur in small firms because their financial statements are rarely audited and they often lack the resources to implement proper internal controls. For example, many small firms cannot afford the cost of hiring enough staff to implement proper segregation of duties. Another more subtle reason why internal controls are not effectively implemented stems from the human psychology. The premise of internal controls is that people are susceptible to dishonesty and that special efforts must be implemented to protect a firm from its own employees. This is an easy premise to accept when thinking about human beings in the abstract. However, it's more difficult to think of your employees as potentially dishonest when you work closely with another person over any period of time. It is natural for trust to develop. The conscientious implementation of internal controls in a small business may send a subtle message that there is a lack of natural trust. On the other hand, it is precisely this natural willingness to trust that gets many small business owners into trouble. They do not make the psychic effort to implement the needed controls because the burden of distrusting their own employees is too great. In fact, the shock and anguish of employers who have been betrayed by trusted employees who have acted dishonestly is often more painful than the monetary loss, which is often insured. So this completes the lessons from my book, Financial Accounting: A Mercifully Brief Introduction. Remember, you can order the book from Amazon or my website, www.understandaccounting.net. The book is also available in ebook format. So thank you very much for watching.